Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Thank you for all the subscribers. I greatly appreciate it. I'm trying to get through all the comments. There's a lot of them, which is awesome. At the same time, it's tough to respond to everybody. So please be patient. I am reading them for sure, and I will get back to you as soon as I can. There's lots of stocks out there for suggestions. I'm trying to get through a lot of them. I hope you've been liking them so far. Today, we're going to look at 3M. Behind me is 3M's annual report. We're going to look through this. We're going to look at their financials, and we're going to look for the cash flow that's in this company and see where we think it's going. So in this channel, we're dedicated to the rational investors. Right? So rational investors buy cash flow. That's what we buy. And we evaluate here all stocks with 5 key attributes as a baseline to begin our understanding of where this business goes and kind of a starting point. That starting point is first top line revenue growth. Got to be there. Earnings growth has to be EBITDA at the enterprise level. I don't want you to manipulate it through NPS or share buybacks or whatnot. That is fake earnings in my opinion because it's just fewer shares outstanding. What we really want is the enterprise level needs to be growing top line and they need to be growing earnings. Then they can buy back shares and grow even faster on an EPS basis. But I want the enterprise to be growing. So then there's debt. We need less than 3 times debt. We don't want to have a lot of debt in front of us if the company should ever struggle. That is cash flow that we want, and we don't have to pay the bank. So less than 3 times debt. A low multiple on the price per share, the earnings multiple. That is the 4th criteria. And then the last one is positive cash flow, actually. Seeing a strong P&L and seeing that P&L performance translate into cash flow, that's what you want. So here we go. Let's take a look at 3M. Behind me is their annual report. There's a couple things I wanted to call out here, namely this chart, which I thought kind of summed up the performance. So sales flat, company struggling to grow. Earnings have been hurt and kind of flat. Flat growth, increasing cash payment of dividends. And you see a lot of companies tout the cash dividend every year. They always announce it. It's big hoopla, hooray for everybody. Good. Glad they're paying back cash. It's fantastic. But if top line sales aren't growing and you're paying out more and more every year, that means you're squeezing the company's cash flow over time, and that cash flow is going to hurt their ability to grow. So it's a double-edged sword. They're committing to grow this number over time, but if they can't grow the top line, then they're running out of cash over time to really with which to grow. Now, they're nowhere near running out of cash. This is simply a point that if the top line doesn't grow and you're increasing payout, eventually you're going to have issues. So that's the point. But it is definitely a note. Let's take a look at the financials and see where these guys are, where they've been going. Okay, revenue. We always start obviously at revenue. Let's see if this is big enough for you guys. Yeah, so revenue, $29.6 billion, or $30 billion in 2011, $32 billion in 2019. Flat growth, that's what you just saw, right? So 1% revenue growth, that is less than inflation. So they are losing top line revenue in real dollars. And if the United States has any kind of uptick of inflation, this is going to be a problem for them. Earnings, EBITDA, again, earnings before interest, tax, depreciation, and amortization. That is the enterprise level. They need to be able to grow this number before we discuss anything else. And here, they grow it at 2%. So $7.4 billion to $8.7 billion, which is growth technically. In this region here is really, really flat. So I think both these don't really check the box for us. It's there. It wants to be there, but it's like, how far do you slice this line of like, well, technically it's above 0, so I'm in. Realistically, we do want it to grow. You want a healthy number. So I'll say that these check the box technically, and we'll move forward. Let's go figure out what the business is worth and how much debt it has on it. So worth, we look at the enterprise value. That's the entire enterprise. That's think of your house. The market price of the house is the enterprise value. If you have debt on the business, that means the equity is worth less. So when you look at market cap is the equity in the house, but the house value is what it sells for on a purchase agreement, and that sale is obviously includes the repayment of debt. It's not just your equity piece. So debt here, this is $5.1 billion to $20 billion. That's a big step up. That's a fourfold increase in debt on flat EBITDA. I'm sensing a problem here. Less free excess cash. They do have some excess cash. It has come down. Again, excess cash we define as marketable securities on the balance sheet, and that's basically cash that they don't need anything with, at least for 12 months, and have parked it in marketable securities because they don't need it for the ongoing operations. Market cap, shares outstanding times average price, $56 billion to $98 billion, kind of doubling over time. Enterprise value, $60 billion to $120 billion. That's a doubling of enterprise value, kind of a combination of market cap and increased debt. Let's take a look at the debt multiple first. Again, total debt divided by EBITDA. So this is the number of years of earnings the company has to pay to liquidate all debt, and it's important. So here it started at 0.7, so less than 1 year. That's essentially zero debt. $7.4 billion of earnings, $5.1 billion of debt. Beautiful. Plus they had cash on hand, right? Excess cash. So that's actually even better position, right? And then what happened? Debt went up fourfold. Earnings are flat. Now they're at 2.3 times debt to EBITDA. So debt is $20 billion. They make 8.7, and it's going to take them almost 2.3 years to pay off that debt. Assuming obviously they took all EBITDA and paid towards debt. Companies don't do that, but it's just a metric. So that means debt has gone up a lot. Still less than our 3 times, but I don't like where it's going. And given the fact that you saw earlier, their dividend payments have been going out. Remember what I was talking about, how you're squeezing the business. If sales are flat, dividend payouts going up, you got to get the money someplace so it looks like they're borrowing it. So that's not great. Let's look at enterprise value multiple. That's 8.1 times to 13.6. That is a doubling of the market multiple. That's a fair price for the business, but a bit high for something that's not growing with some debt on it. So that kind of is what it is. I don't have much of an opinion. It's neither too expensive at 13 times nor too cheap to really, really love it. Let's look at cash flow. It's where the rubber meets the road anyways. I mean, what we're buying is cash flow. So 11 to 19, $5.2 billion to $7 billion, 4% increase in cash flow. That butts up well with the 2% EBITDA growth. So we know the P&L, the profit on the P&L statement is translating into cash. That's a checkbox for the accountants. Good job for the 3M accountants. CapEx here's pretty flat, growth 3%. Actually, considering their top line revenues flat, 3% growth in CapEx is actually strong. Look at the delta here. They generated $7 billion of cash flow. They put back $1.5 billion. That's a strong free cash flow. That's $5.5 billion that they get to keep from operations. Those are healthy margins on their products. So they might not be able to grow the top line. They might not be able to grow bottom line that much, but the margin they have is strong, which is nice to see. Debt, these positive numbers here, as you can see, this is because they're borrowing, right? So they're paying down stock, which you can see right there. They're buying back stock with flat revenue, which means they're buying it with debt. That's what's going on here. I don't think there's any surprise there. The margins are nice, but they are borrowing, which is not really what we want to see. And you can kind of see that in the high yield. I mean, this is an above average yield, 6.4%. This is showing 9 right now. That 9 is too high, and you can see here last year debt, $3.5 billion of positive debt. Let's see if we can't find that for you. If I zoom out, let's go to their cash flow statement and actually look at where the debt is, because I have a feeling that what they did, that's unusual. So here's cash flow statement. 2019, this column, remember first third operating, middle third investing, bottom third financing. And you can see right here, proceeds from debt and repayment of debt and proceeds from debt. So these two columns here, $6.2 billion is a lot of debt. It's an unusually high number for them. They borrowed previously 2.2 billion. If I go over one more column, they borrowed $2 billion. So they're typically borrowing about $2.5 billion, and they're paying back $1 billion. Here they borrowed a whole lot more. So what we're going to do is we're going to adjust that down, because this cash flow 3.5 positive isn't really cash flow they can dividend out. This would be more like the 1.5 range. So going forward, when I look at the cash flow and the yield, right here, so this is cash flow per share. This is free cash flow per share. I'm taking this column divided by shares. I get this, 9, 10, 15. That 15 is too high. If I adjust this number down, this is like in the 11 and change range. So what I'm going to do is I'm simply going to average the last 3 years to give me a rounded average number. This happens to be 11.9% is the average, and I'm going to grow that going forward. So just when we look at cash flow growth, that's what's happening here. I think this number is just too high to peg for a forecast. So I'll average these and then forecast the average. Let's go take a look at EBITDA and see what we get here. So EBITDA, I'm growing at 2.1%, just keeping what they've been doing on EBITDA going forward. Obviously revenue, they need to figure out how to grow, but I'm saying that they'll get it. And EBITDA is moving forward. So we started at 8.9 billion and grow. Let me get to the top so you can see it. 8.9 billion and grow to 10.7 billion dollars. I'm applying a 12 times multiple to the business because I think it's appropriate priced. It's a strong margin business. It's sticky. It's industrial. It's a well-run company. Their issues, they can't grow the top line, but they generate plenty of cash. They're not too overly levered. I think 12 times an appropriate business for something like this. Less debt plus cash gives me a market cap of $116 billion. Less shares outstanding, $200 a share. Okay, $200 a share. Here on the cash flow side, so again, cash flow, I took this $12.20 is the average of the last 3 years, grown at 2.1%. And then I grow that every year going forward to $14.66 in fiscal 2029. I apply a 5% yield to that. Currently, they're trading at a 6.4, or excuse me, that's average. Currently, they're at 9. That is unrealistically high because, again, they had that high debt payment. This is above average, which is making this number above average. So I'm right sizing it back in this range here, giving it a 5 handle, and that puts the price target just shy of $300, which is good. Okay, so we got 2 price targets, one from cash flow and another from an EBITDA market multiple approach. Let's take a look at what this means for a return. So it's currently at $163. I've got 2 different metrics. 193, 200, I'll average for $248, close to $250 of a long-term price. If I come in here, I say to an IRR, I can buy it at 163. I'm going to grow it. I'll get these cash flows. They may be dividend, they may be not. That's okay. In the end, I get 240 based on the cash flow multiple and the market multiple. My IRR is a 13%, which is slightly above market. 13% is a nice double-digit number. It's very robust on a company that has strong margins, but's not able to grow top line. So 13% over the long run, or 2.3 times your money. All right, let's look at a distribution. If this were to change. Let's see, this is actually 163. This is times 1.1. Sorry, this got stuck and I didn't update it. Let me just update this for you. All right. There you go. So 163, this is the current price and this is the current economic return. As the price increases, the return drops. So if it goes up to close to 200, you're looking single-digit IRR. If it peels back, I think it gets very attractive here. But in this channel, we're going to be a pass on it. I don't like that the top line revenue isn't growing. The EBITDA growth of 2% is still a guess because they've struggled recently to really grow earnings. And it's just too close to zero for me to really get my arm around. And it's not quite cheap enough to really want to just take the cash and run. So we're going to give it a meh. Because again, top line revenue growth isn't there on a real basis. It barely makes it. EBITDA growth was flat. No, it was 2%. That's what I used. It was 2%, which technically meets, but I didn't like it. It's not strong enough, and I certainly don't like the top line not growing. Cash flow is strong, so I think that's what's underpinning the business. Is they have strong margins, they have still relatively low debt, but debt is growing, and I don't like they're using growing the debt to help with the dividend yield. So we're going to be a pass, but good company. Hopefully they can find a way to grow the top line. My name is Cameron Stewart, CFA. This has been a review of 3M. I hope you liked it. Please comment, hit the subscribe button, and talk to you in the next video. All right, bye-bye.